because of that outsized production, we had prices temporarily below $3. So we spiked above 4, and then we cratered because of a relatively mild August. But the way we think about the back end of the year into the prime winter season, we still feel confident as long as we can get that demand uplift that we could threaten 450 to 5.
Are we really going to see a big surge in demand for U.S. energy products over there in Europe?
I mean, we already see a lot of demand and it will continue to grow, but it was window dressing. 750 billion, 250 a year, 26 through 28. It's unrealistic. It's not legally binding. The countries don't control the companies, right? It kind of reminded me of what happened in 22 when Biden, after Russia invaded Ukraine and Biden said, we're going to send, more LNG to Europe. It was already happening. It was already underway. It's going where the price dictates.
So the region is still being actively tested, and there are some technical hurdles like rock complexity and heat at the wellhead, but operators have been working through that, and productivity has been improving to the point where the type curves there are starting to rival those in the Haynesville. What really makes that play, though, so interesting is that we had a deal like EOG acquiring Encino for $5.6 billion. And really, we think that that's going to be the harbinger that larger public operators see the opportunity to piece together more fragmented pieces of acreage and morph the play from what was once viewed as a secondary option to the Marcellus into a more competitive core production area.
Good morning, good afternoon, everyone. This is Rob Barnett, and I'd like to welcome you to today's BI Energy Exchange. I'm calling in from my car because I'm about to fly to Houston and will be catching a flight momentarily. But on the call today, we've got several members of the Bloomberg Intelligence team here in North America. We've got Vince Piazza calling in from Wilmington, Delaware. We've got Tellen Custer calling in from Princeton, New Jersey, and we've got Matt DiMarino calling in from our New York City headquarters at 731 Lexington. So welcome to the call, everyone. And today we've got, I think, the right crew to discuss what's going on with the natural gas markets here in North America and globally. So Vince, I want to come to you and just do a quick commodity pulse check-in. How are you reading the gas market here at the moment, and what's your expectations for how things might unfold this winter?
Well, look, we started out pretty strong in the month of June. Our call was for natty summer to hit $4. It did sooner than we expected, and then it just rolled over because of outsized production. In fact, at any given time throughout the course of the summer, year over year production was running anywhere between 4 to 6 BCF above the prior year. So really robust production across the landscape, but more so in the associated gas region, like the Permian. So that was quite strong. The demand side of the equation, hey, you know what? Demand wasn't really that bad, despite the fact that we had, cooling degree days running a little bit softer than expectations. We still had some good demand call, and that's primarily because of LNG, which helped out. Take a step back, look at it from this perspective. Because of that outsized production, we had prices temporarily below $3. So we spiked above 4, and then we cratered because of a relatively mild August. But the way we think about the back end of the year into the prime winter season, we still feel confident as long as we can get that demand uplift that we could threaten 450 to 5. Now, we're not saying that's the average, but we're saying that, we really haven't had blistering cold weather this in any winter in the past several years. So we're likely due, but I think this pace on the output side doesn't really make a lot of sense. Now, Appalachia gas is what it is. There's really not a lot of new infrastructure that's going to drive growth. Associated gas in the Permian. Our view here is that we're pretty much bottlenecked on the takeaway side. So we probably don't see as much growth there. So we are cautiously optimistic that we could see that 450 to 5 as long as we get that demand uplift, both on a cyclical basis. And I think Talon can talk about where we are on the LNG side, but I think the LNG is progressing according to plan for the most part.
Vince, you mentioned demand factors, and I want to get a sense. What are the things that you're looking at? Are you mainly looking at weather-related factors? And what do you make about some of the secular trends related to both LNG and data centers? Anything else that's sort of fueling growth there in the segment for you?
Yeah, so I think Matt really put out an interesting note last week highlighting LNG and AI demand, and he can get into that later on. But I think there are two factors, right? There is the secular growth trajectory from AI demand and LNG sendouts. Then there's the more cyclical component, which is pretty significant, and that is the industrial side of the house, which continues to grow. The economy is doing fairly well. And we also have the resi and commercial side, and that's really more of a GDP minus because of the conservation that we've seen both in the residential side and also on the commercial side, seeking efficiencies. So we're really not looking for that significant growth on the cyclical components. The real structural demand is going to come from LNG over the course of the next 3 to 5 years, and also AI, which is more longer term. Now, I think, we could all be very bullish on this, but I think a more conservative trajectory because of the bottlenecks in getting what we need to backfill that growth in demand is really significant. So whether it's infrastructure behind the meter or it's new capacity being put into place by utilities. But the growth trajectory is there, but it's probably a little more elongated and a little more delayed than we think. But it is there, probably a stronger growth trajectory for natural gas than, say, pure crude oil 3 to 5 years out.
Yeah, very interesting, Vince. I'm going to come back to you in a few moments on some of the supply side dynamics that I'd like to get into. But Talon, let's come over to you. Want to get your pulse on the global LNG space. And I will maybe start with this idea. So President Trump's over in the UK right now. I think they're having discussions about industrial policy, chips, and relationships around energy, gas, nuclear, on down the line. And you've got a note out late last month looking at the dynamics between the US and Europe. And specifically, there's this idea of 750 billion of US gas, and I mean, it might be more than gas. It may just be broadly energy going to Europe. But frame these numbers for us. Are they realistic? Are we really going to see a big surge in demand for US energy products over there in Europe?
I mean, we already see a lot of demand, and it will continue to grow, but it was window dressing. 750 billion, 250 a year, 26 through 28. It's unrealistic. It's not legally binding. The countries don't control the companies, right? It kind of reminded me of what happened in 22 when Biden, after Russia invaded Ukraine, and Biden said, we're going to send more LNG to Europe. It was already happening. It was already underway. It's going where the price dictates, right? So the EU imported about $80 billion worth of energy products from the US last year. A quarter of that was LNG. It'll increase this year. About 59% of US LNG is going to the EU, 71% if you include the UK and Turkey. So let's say 20 billion of LNG purchases last year. Let's say that doubles to 40 billion, which that's what we calculated based on average prices and the current pace of trade. That gets you to roughly 100 billion for this year. You still have to increase that 2.5 times for 26. So it just seems unrealistic. And obviously there's a ton of US LNG capacity coming online, so they can import more of that, but prices are going to come down. So that's going to put a dent in the total amount. So the other factor too is Russia, right? They want to wean off of Russia energy. They plan to do that by the end of 2027. They imported 23 billion of Russian energy products last year. So that's another opportunity to kind of take the US and push Russian supply to Asia. But again, it doesn't put a huge dent in that figure. So I don't think it's attainable, but as a whole, it may look like a win to some because it's a big headline and looks like Trump won on the trade war. But as a whole, again, a lot of US energy products are still going to go to Europe. I just don't think it's going to reach that amount.
I'm curious how confident you are in the 5-year demand trajectory in Europe. So I'm gathering most of the LNG is flowing from US to Europe. What if there is a peace agreement between Russia, Ukraine, and Europe's on board with it? Does that ultimately negate a little bit of the need for US LNG? Does it affect the demand calculus that you've got in your mind for how much LNG exports would flow out of the US? I guess my question is, if Europe decides it will accept a little bit more Russian crude, are there other homes for North American gas outside of Europe?
Yes, there are. So I think at this stage, it doesn't look likely that there will be peace, right, anytime soon. But let's entertain the scenario that there is. I do think that we'll see, we've seen 4 US LNG projects reach FID this year. I expect at least one more by the end of the year and a couple next year. If there was a peace announcement, I think that kind of stops because there's so much capacity under construction in both the US and Qatar. I think it will be more price driven. I think there's still room for the US LNG being built. Number one, because most of it is backed by contracts. Now there are outliers. Golden Pass is portfolio. It'll be on the spot market. Woodside's Louisiana LNG will be on the spot market until they sign some more contracts. But the other projects are backed by 15, 20-year deals. With that said, a lot of it is portfolio players and is still technically spot. What I think happens is, prices are already going to come down with all the capacity coming online. Prices come down far enough, it spurs that much more demand, particularly in areas like Southeast Asia. So I don't want to spin that into a total positive because it's not. I mean, obviously, if Europe takes Russian gas again, that removes quite a bit of LNG demand from the US. So it's definitely not apples to apples, but there is room for US LNG to go other places. But I think we see this rapid build out halt if it came to that, and LNG prices would be lower for a while.
Okay, thank you so much, Talon. Again, for anyone listening, if you are in the Houston area and you want to come to the event taking place tomorrow, just shoot me an IB. A couple of you already have. Happy to get you the details on what's taking place. With that in mind, one other bit of marketing. We are in the midst of conducting an energy market survey. I'm going to drop the link in the chat. If you're on the call, you also probably got an email from me about an hour ago reminding you that the call is taking place. The survey link is also in that email. We ask your expectations for oil prices, OPEC policy, what's going to happen with gas, renewables on down the line. We're curious. We want to know what you think about the world, so that it's not always just our views. Okay, let's shift gears. Matt, Vince already teed you up a little bit, but I do want to get to this note that you put out last week that I thought had a very provocative set of conclusions. And you're pretty much were looking at the gas market in Appalachia and tying it to some of the themes we've already hit on a little bit with LNG and AI data centers. But give us an overview of what your note's about and what you concluded.
Yeah, thanks, Rob. Yeah, so we put out this note last week on Appalachia, and the way that we look at it is that Appalachia is in a really different place today than in past cycles. So to start off talking about the different plays here, if you look at the Marcellus, it's essentially a more concentrated play at this point. Generally, you think of it as the anchor for the Northeast in terms of natural gas production, and it still should be supportive and bolster the demand story, but most of its prime acreage is already in the hands of large cap operators. So there just isn't a lot of open ground left for M&A or for new entrants to move the needle in a meaningful way. So where the story is shifting is the Utica. So the Utica, being the sister basin, is not so much a wild new frontier, but it could be a consolidation engine. So the region is still being actively tested, and there are some technical hurdles like rock complexity and heat of the wellhead, but operators have been working through that, and productivity has been improving to the point where the type curves there are starting to rival that of those in the Haynesville. What really makes that play, though, so interesting is that we had a deal like EOG acquiring Encino for $5.6 billion. And really, we think that that's going to be the harbinger that larger public operators see the opportunity to piece together more fragmented pieces of acreage and morph the play from what was once viewed as a secondary option to the Marcellus into a more competitive core production area. And this is important because scarcity value is only going up, and these regional upstream players, they saw how the Marcellus got locked up. They're not going to want to get shut out of this area's potential with LNG and power demand on the rise. So we see that consolidation trend continuing, particularly in the southwest part of Appalachia, so West Virginia, parts of Pennsylvania, but there's still a number of smaller and mid-sized players with good positions. That's where the next wave of deal making likely gets concentrated. The strategy, though, in that part of the basin isn't just about chasing every production corridor. It's really about being deliberate and stitching together contiguous acreage and midstream assets in a way that creates real operating synergies. So because infrastructure is so scant there, it's overall a lot less forgiving in terms of getting boxed into a weak position or missing out on a strong one if you're not looking where you leap. I would close out by saying that, overall, overlaying all this is the demand picture, which we've already spoken to some degree, which is really what is giving Appalachia its edge and a purpose for these upstream companies to develop strong positions. So Virginia alone, which is within extremely close proximity, hosts about a quarter of U.S. data center capacity that needs to be fed. And on top of that, more in Talon's world, we've also got LNG terminals pulling heavily from the region as well. Just in the last couple of months, you've seen upstream companies like EQT signing 20-year SPAs with Gulf terminals. So that combination of AI-driven power and LNG exports creates a pretty large demand vacuum for gas in the next few years. As Vince alluded to, though, the challenge being infrastructure to match this upcoming pull. And while we've had maybe a handful of projects that could help the area's takeaway, pipeline capacity still risks being a limiting factor there. But we think that plays back into EMPs needing to be smart about what we believe is going to be a pretty robust consolidation cycle.
Matt, let's noodle a little bit more on the pipeline constraints. And are you worried that within the Appalachian Basin, you could effectively have sort of a mini oversupplied market if there's not enough takeaway capacity for the gas that's potentially going to get produced?
Yeah, so that's definitely a risk. We actually just went to Pittsburgh. We were there at the Appalachian Drillers Conference. Um, some of the panelists there actually mentioned exactly that, and that's that when you have a basin that becomes more consolidated and you have fewer players that compete with each other in the basin, it's a lot easier to look at your neighbor and say, okay, well, I'm competing with you on a production basis, and the production within the basin jumps up and those differentials collapse. So without the continuation of some of these smaller takeaway projects like MVP expansion, Borealis, Nessie, those sort of infrastructure projects, there really is a risk of oversupply in Appalachia. But ultimately, the risk to pricing there is really at the wellhead. The demand should still be able to support and take the supply, albeit it will just get a little clumped up in the region.
Okay, very interesting. Looks like we've lost Vince for the moment, but Talon, this is a good opportunity to bring you back into the conversation. Part of your coverage portfolio is that you look after a number of the midstream operators for us, and I'm curious, you know, when you hear about sort of generally Matt's discussion around potential pipeline constraints, can you give us a lay of the land? You know, how much investment in pipeline capacity is underway? Are the midstream operators in the midst of a CapEx cycle where they're trying to make sure all the necessary pipelines get built? And what's your general outlook for connecting the producing regions to the demand centers?
Yeah, I mean, I'm pretty optimistic. There's a lot of midstream companies that have significantly raised CapEx, those natural gas focused companies. Obviously, a lot of it is concentrated around LNG, the Gulf Coast, the Southeast. But, Matt just talked about Appalachia and the Northeast, and we're seeing, some optimism there too. So the Trump administration has put, they've delivered on promises surrounding LNG. That pause in 2024 is over. Multiple projects have moved forward. We're seeing kind of trade-offs with wind and, if you allow some of these other projects to go through. So you have Williams Northeast Supply Enhancement, just a 37-mile pipeline between New Jersey and New York. It was scrapped in 24. Now it's being revived. That could get, I think it was about 400 million cubic feet a day, something like that, in an area of need. Matt mentioned the Borealis project, which is a 2 BCF a day project to get Appalachian gas west. Any of these outlets would be huge. The Constitution Pipeline, Williams is starting to get the ball rolling again, gauging interest. They're not going to pursue that too heavily until they have, buy-in from all the necessary parties, but that's another 650 million cubic feet a day or so. And then, MVP Southgate. MVP was huge in the sense that, it took an act of Congress. It was the first massive interstate pipeline built in that region because production has been little changed, even though there's the potential for the amount of gas that can be produced there economically is massive, right? So MVP gets built, but it's kind of a dead end because there needs to be more expansions at the end of it to get more gas south, southeast, southwest. That's where MVP Southgate proposed project comes in. Williams Southeast Supply Enhancement, which is 1.6 BCF a day. So there's a number of projects being proposed that could really help. And then you have, we've already mentioned behind the meter, right, in basin demand for data centers. So there's more outlets. Obviously we have to be cautiously optimistic. It's not going to be this massive build, but there could be some projects that come online and help alleviate the constraints that have been a burden on this area for so long, right? And the data centers, TC Energy and Williams come to mind. Those are always the two with the largest networks in the Northeast that benefit from these expansions and data center and power demand for AI.
Talon, I'm curious, to get your, because politics comes into all of these matters a little bit, and I'm curious, are you seeing any indications that the Trump administration has been able to clear the red tape on the permitting process, whether it's pipelines or LNG export facilities, just infrastructure generally? Do you get the sense that companies are able to move a little faster? Because I feel like that's been a promise of the administration. Or is it still, are we still in kind of a wait and see period at the moment where we really aren't seeing any significant acceleration? Give me your sense on sort of how quickly FERC and the other folks can get stuff permitted.
Yeah, FERC wasn't really the issue. It's the other side of it. But we are, there's still a lot of work to do on the regulatory front. That's for sure. I want to preface it with that. There's still a lot of work to be done, but he has delivered, and companies are moving quicker, right? We went from a complete pause in 24 to, calling out next decade's Rio Grande project that, had its FERC certificate vacated, returned to it. Then it was returned, but it wasn't vacated, so they just had to redo an environmental study. They quickly did the supplemental environmental study. They got the final study done, and it received FERC reauthorization earlier this month. And that was just one project that went through it. So we're definitely seeing some movement. And I think the Williams Northeast supply enhancement is another example of that. It was dead in 2024, abandoned. And, Williams is pursuing it. And it seems to be I don't know how firm it was of a trade-off that, they could do a wind project in New York if we also can do this, but we're definitely seeing an acceleration in certain projects. With that being said, still a lot of work to be done on the regulatory front.
All right. Thank you so much, Talon. We will swing back around to Vince now. Vince, I think you've been able to rejoin us, had a little bit of technical difficulties.
Yeah.
And you've missed some of the conversation, which has been very sort of infrastructure and demand focused. But I'm curious to get your read, Vince, on what are the best sort of estimates for what the supply curve looks like for natural gas in North America. So for a long time, we had this idea that there was this lots and lots of gas available at a pretty low cost. Is that still true? And how does that feed into your expectations on what could happen with prices?
Well, to be clear, I have been quite wrong on the amount of output that has come on in 2025. I am amazed at the level of efficiency gains that we've seen. CapEx really hasn't grown that much year over year. In fact, that discipline has been fairly intact across the board. But what is amazing here is the amount of gas growth that we've seen without the growth in frac spreads, without the growth in rig count. So the efficiency gains have been pretty strong. And yes, it's mostly come from the associated gas side, specifically from areas like the Permian, more broadly Texas as well. But I have to say that we're going to need to scrap the usual correlations that we've made relative to production and the rig count and the frac crews. The frac counts being the most relevant. At least they were the most relevant. That isn't the case anymore, it seems. And so we need to go on back and relook at and adjust these historical correlations that we've made in general. But if we were to get the infrastructure uplift in places like Appalachia, And if more gas infrastructure were to follow on places like the Matterhorn, I would really see a more significant uplift on natural gas production, but I don't think we're there yet. I mean, I think that with the M&A that we've seen assets in stronger, bigger hands who are more apt to appreciate capital discipline and capital efficiency and productivity gains as opposed to brute force growth on the spending side to push out more molecules. I think it will be more coordinated. I may be wrong again, but I'm going to stick with that point of view because I think that the operators understand that production growth is not a way to win over the next 3 to 5 years.
Okay, Vince, thank you very much. We are quickly approaching the end of our time here, so I want to wrap things up momentarily. Just FYI, I dropped a link into the chat for some of our general research on AI and data centers and how that's affecting things in the power market. And obviously there's read across into gas as well. Talon, there were a couple questions related to LNG that came in from some of our clients who are listening, and I wanted to give you an opportunity to maybe weigh in on at least a couple of the ideas. But most saliently, and this relates to some of your earlier comments, but do you have any views on whether Russian gas could be diverted to China? And I think the sort of natural follow-on is I get the sense that Chinese LNG imports have been declining, but give us your read on where the numbers are on China and its role in LNG and whether you might be seeing more Russian gas actually headed to that market.
Yeah, Chinese LNG demand is down. They've kind of flip-flopped with Japan, whether they're the largest or second largest LNG importer. We had forecasted that it would decline 16% this year. We expect it to grow next year. China's just very, they're cautious about, the diversity of supply and conscious of price, right? So they have domestic output increasing, they have pipeline imports increasing, so they don't have to, bring in as much expensive LNG. So, then you have that announcement where, Russia says it's firm. We don't know how firm it is yet for Power of Siberia 2, which would be 50 billion cubic meters. Also a 2 billion cubic meter increase in the Far East pipeline, and then a 6 BCM increase on Power of Siberia 1. All of that included would take out roughly 43 million tons of LNG demand. And that would be, I'm guessing, 2030, 31, somewhere in that neighborhood, based on how quickly Power of Siberia 1 came on. So China's interesting. I think when LNG prices are lower, they will import more, and prices are going to come down in the latter part of this decade. So I don't think LNG is going away for them, but if that Power of Siberia 2 is built, and China has so much leverage on Russia, right? Russia needs China a lot more than China needs them. So I'm assuming they would get very favorable terms and prices. So that would be a big win for them. It also opens the door for Europe. It would kind of be a switch, right? A lot of Russian LNG and gas would go to Asia. A lot of the US supply would go to Europe. But yeah, that's 43 million tons would be equivalent to about a tenth of current LNG supply this year. It's not insignificant at all. Obviously, LNG is the market's going to grow a ton over the next 5 years. So it's a big deal. It is a big deal, and it would definitely shift LNG trade and impact it for the next decade for sure. And that would be another thing. We mentioned the the scenario where if Europe took more Russian gas. If they don't, but a lot more Russian gas goes to China, 50 billion cubic meters would be about, I think, a third of what they were sending to Europe prior to the invasion, something along those lines. So they really regain a lot of what they lost. It would be a big shift. Definitely takes out a decent chunk of potential LNG trade growth.
Okay, fantastic. I think we're going to have to leave it there. Thank you, Talon. Thank you, Vince. Thank you, Matt. For anyone listening, please do take our survey. We do want to hear your thoughts on the market as well. And we will be sharing the spectrum of results from that sometime, probably starting next week. So stay tuned. And if you are in Houston and you've IB'd me about the details on our event there tomorrow, I will respond momentarily and get back to you. And everyone else, have a great rest of your week. We'll see you next Wednesday, same time, 10 a.m. New York. Cheers. Bye, everyone.